2022, I was asked to do a video about our strategy like we used on Facebook yesterday. And basically what it comes down to is during earnings season, what I like to do and what I found that I like to do besides, going out and just gambling, um, and buying at the money strikes and waking up the next day and realizing that you just lost a ton of money because you have no idea which way the market is going to push or one of these names off of their earnings report, right? I will tell you this as a disclaimer is I feel technicals still weigh very heavy on earnings, and it's really interesting to see that play out because we will dip into demand zones and push up. And that dip into the demand zone might have been like a CEO saying, hey, we're going to um, the first the numbers are bad, it dips down into demand, and then the CEO says, "Hey, we're doing a $50 billion buyback," and then it pushes up. And a demand and supply trader would just look at it and go, "Okay, it just dipped into demand, and we buy the demand zone." Right? And that's where I really want you to understand this strategy itself when looking at earnings. We don't know which way they're going. So, what we try and do is identify zones right before their earnings. Okay, like the day of, the day before. Sometimes the day before, you'll get a big move and your zone might get hit. So I typically like to do it the day of. Okay. So for example, let's just pretend because we took Google off this trendy edge here, which also happens to be a demand zone. We took it off of this level this morning. We've already trimmed, but I want to give this as a scenario, and then we'll do one together, like on Apple, maybe Amazon. We'll actually do Amazon, and I'll give you guys some examples. So if this were going into earnings, the way that I would look at this is that I found a demand zone, okay, and it's right here. And we could see if we zoom in here that this is a very powerful candle. Why do we know that this is a powerful candle? Well, when we compare it to the other candles, it's a lot bigger, right? This candle does not look like the rest of the candles. Therefore, we know that there's a lot of demand here. Okay, so we have this demand zone that's showing up on the screen, and quite honestly, it's really easy to identify by just looking at it. And I was teaching this just the other day ago to one of our members. He's like, "Man, it's such a simplistic way of looking at it," and it really is. And this is where I talk about volume. I don't need volume on my chart because this candle right here tells you that there's a lot of volume behind this structure. Right? I think you guys would all agree with that. But if you want, you can pull out your tools that identify volume and you'll probably see it there. So, because we are coming into demand here, let's just say, for example, Apple and Amazon actually report tonight. Well, what if it's bad and Google continues to move down? Now, I'm long 85 days out, all right, because I'm in a demand zone and I really don't know, one, if the demand zone will work, just being honest. And the second thing is we don't know the time. Timing is the variable. So the idea is that I'm wrong on my timing, okay? So I want to buy more time to the upside, all right? I want to buy more time to the upside because I don't know if this is going to work right away. Now, on the idea that prices pull back for their earnings, I want to use different levels within the demand zone because what we find is that when we dissect the demand zone, there are different levels within the zone. Like, for example, the way that I use this would be underneath this candle right here would be the entry, which happens to be my YE, right? And then I would use this wick as my next target. And then I would use the bottom of the zone, which would be my next target. Okay. So let's go ahead and do that. So we come down here. I'm going to click on this wick. And then I'm going to click on this wick. Now, the numbers that we get out of these would be the idea for a debit put spread. Okay. A debit put spread. So if I'm wrong and price dips below, I do believe it comes down to the next level here. So the way that I look at this is I can do several different things. Everybody has different risk, right? Some people like their debit spreads wide because they can capitalize more money off of the move. And some people consider very tight debit spreads as a lotto, which I would have to agree with, because really what you're doing is taking two out of the money options, which have a low probability of working according to the math that's on your option chain. But in my experience, market makers, from what I can understand and see, don't necessarily have the same strategy as that we have. So sometimes we can see that things are underpriced because we can see the levels and we see over time that these levels work, so we have an advantage on the market. That's how I look at it, right? We actually have an advantage. And so sometimes these are underpriced. Well, in this example, we got into this trade, what, like at $3 or three and some change or something like that. And, and then we trimmed or whatever at four. And I want to find something that is possible to the downside short term that would actually help finance this 85 DTE call that I bought. All right. Now, in this case, like I said, we're probably shooting for, let me just check and see how much I paid for this trade. All right. And let's go up to, and it looks like I paid $3.50. Okay. So we know that we paid $3.50. Now, that might be hard to do. It just means we might have to buy more contracts on the on the put side, on the debits. Okay. But what I do have is numbers here. We're currently at 93, trading at 93, and we could possibly see 90 by 86. Okay, 90 by 86. Some things you have to take into consideration is if we hit 90, we will most likely bounce. Okay, if we hit 90, we will most likely bounce. Notice my arrows here. Now, why is that? Because this is just a next level. Remember, every level to the downside on trendy charts is support until proven otherwise, right? So if I were to buy a debit spread of 89, let's just say 90 by 85, would that be smart? It could be. It could be like the Facebook one or the Meta that completely tanked and it worked. But if you buy those, most likely what's going to happen is after hours, you're going to just break down. You're going to be really happy after hours, but then you wake up and we're actually bouncing out of the numbers. See what I mean? So in this case, a safer trade would actually be buying under the trendy edge and saying, hey, let's do a 92 by 90. Does that make sense to you guys? Does anybody have questions about that? Okay, cool. So again, if we come down into here, this just makes more sense. And this would be into tomorrow. Okay. So this is under the idea that, earnings is tomorrow. But I can also apply this strategy, Bucky, to the fact that Apple and Amazon are reporting, okay, which is kind of neat. So we're going to take that level off of there, and we're going to look at tomorrow's expiration, okay, and we're going to go with a 92 by 90, okay. Now the 92s are only 30 cents, so we already know this is going to be cheap. These are 25 cents, guys, okay. So 92 by 90, 25 cents, almost just like the Facebook. And these are going to pay $175. This is almost the same exact risk to reward that we did on Facebook, or Meta. Sorry, I keep calling it Facebook. All right. Pretty crazy, right? And it is a possibility that it does not hold here. All right. There is a possibility that these two could tank the market. So it's a nice risk to reward. So what does that mean for us? We only have to, what do we have to do? Anybody know? We only have to buy two of these, okay? Two of these. We have to pay $50, right? That's it. $50, and we're going to get 176 times 2. Okay, 176 times 2 equals 352. 92 by 90, sir. So 2 contracts, 92 by 90, weekly expiration, total or potential gain, 352. And how much did I say we paid? 350? Yeah, puts. Yeah, let's put that. Uh, okay. And I believe we paid 350. Yeah. Yeah, right here. Guys, I mean, for a Friday lotto, in case Amazon or Apple drops, this would be a great strategy. And you actually pay for this. So, what could happen over the next 85 days could look like this. Okay. We drop and we close here tomorrow. We finance our long 85, sorry, our long 85 DTEs. These are free, literally free trade. And you have 85 days for this to come back, take its time, and roll back up. See what I'm saying? And when you go back and look, the overall demand zone worked. Oh, it's all good, Dave. So we bought 85 days out the 100 calls in Google on the dip this morning. We've already trimmed at 4. But this, what I'm showing is how we use the meta strategy and how you can apply it to really any earnings or for a particular trade. Now, there is a disclaimer to this. Both of these could end up doing crap. Maybe. Let me show you what I mean by that. I have to talk about this. This is a Friday expiration. Okay. Let's say that Apple and Amazon don't report well, but the pullback, let's say we actually move up towards today. This thing goes to like 95 today. Okay. So about right here. And then when we drop, because Apple and Amazon report hypothetically bad, we drop right back down to the edge. These expire worthless. So you lose $50. And we wake up on Monday and we're down here. Everybody understand that? Everybody understand the risk here? So what you're assuming really, and how I want you to think about this trade, is you are assuming $4 of risk no matter what. Everybody understand that? You're assuming $4 of risk. You're taking on the 350 that you already paid, and you're taking on the $50 for these 2 debit spreads to cover 1 contract. Okay? If you're okay with that, and that's what really gets me to execute a trade, is that I am comfortable with my risk, and that's why I hold it overnight. If I'm not comfortable, I shouldn't be in the trade in the first place. And that's what I'm really trying to teach you guys, is that what you go home with is what you will wake up with. And, well, I shouldn't say that. The price could be gone, right? Okay. So in this scenario, that's what that looks like. Now, will I hold the long call? So that's a very good question, Brian, right? And in this situation, on a long term chart, this is hard, right? Do you stick to a 50% loss or do you stick to the technicals? Because we have 85 days. I mean, look how things changed so quickly with AMD this morning, right? Now, I will tell you it's a lot easier when the charts look like this. And the reason why on the long side, Brian, because that's a great question, man. So let's just say that we're right here, right? And I'm telling you guys, hey, we could buy debit spreads here. My answer to you, Brian, would be yes, we are going to stay in the long term call as long as price stays above the cloud and does not break below. Does that make sense? So Brian asked me, will you hold a long call regardless with a 50% stop? And again, I think the scenario is a lot easier from a bullish standpoint. Okay. But we can apply those same rules to over here. You can hold the call as long as what, Brian? Let's see if you're on the right page. Anybody, actually. As long as what? Nope. So Brian said the 38.2. Actually, as long as we're holding the demand zone. Because what if we dip in here? Well, first of all, we'll get paid. But it could even look like this. And then all of a sudden, look like this in 60 days. Okay? Into Christmas. You don't know. Right? So the idea is we're buying into a demand zone. We don't want to get stopped in a demand zone, do you? That's like makes you feel dirty. Yes, you did hear both, Bucky. So these debit spreads to protect the long-term trade is tomorrow. Those are weekly. That's why they're so cheap. They're $50 for two to cover the long-term calls. Make sense? Yep. So you let the demand zone play out because the worst thing is getting stopped out in a demand zone. Yeah, so you're buying two separate trades, Bucky. Yep, two separate trades. This trade into earnings, that's what it's all about. Okay. I'm bullish. Let me make it clear. I'm bullish because we came into a demand zone. I'm bearish and want to pay for this short term because the overall trend is down and it's 2022. Okay. Example. Let's go to our Meta trade. Okay. Okay. This was the same trade that we did last night. Okay. So last night, I did a debit spread to the upside. Okay. So this one is different because we did two different spreads, Bucky, into Meta. All right. And the reason why we do two different spreads is because of risk, right? So we only paid, and I'll draw it on here real quick. We only paid $1 to hit this spread. Okay. $1. Bullish long term. $1 was 1.11. Okay. Short term, we found a zone to the downside and we bought debit spreads. Okay. So debit spreads look like, I think they were way down here, like this. Okay. And we collected $1.87. Okay. the entire trade was paid for, right? Because this was $1.11 and this cost us, I think, 25 cents. You guys can go back and look at that. It might have been 26 or 27 cents. But if you add this to this, it's still not more than this. So we actually profit from the trade, and this trade is now free. So what I did on this big dip is that I bought back this side, and that leaves us only long this call. And those calls, when I bought back the short side, were only going for, I think, 20, like 22 cents. And now they're trading at 31 cents. So really, I could sell this right now and I made $1.87 plus 32 cents, almost $2. And I only paid about $1.30 for the whole entire trade, but I still have 85 days left. And we all know that 85 days is a long time, right? Crazy. All right, now let's look at Amazon and just start from the start, okay? From the beginning. We're going to run through this with you guys. Now, what I'm going to do, I'm actually going to go to my trading view, folks, because this is where I love this, okay? And let's go to Amazon. All right. Now, if you guys are listening, then I would like for you guys to engage and see if we can come up with stuff. Okay, so we're going to remove the drawings. Okay, and we are going to remove everything here and make this really, really clean. Okay, now the first thing is we want to take structure into consideration. Like, look at this is what I love about TradingView, by the way. See how easy you can compact everything here? Like, I could take Fibonacci's from all the way back, and it doesn't have to be perfect. And I could come up here to the pivot high, and you would see that we are at a very crucial level, right? Of the all time, we are underneath the 38.2, okay? So I want to identify this level right here. I want to have that level on there, all right? Why? Because that's the bullish zone, okay? And that's at 116.78. Current price is at 113. And now from a monthly, I want to see if I can see any other zones. Ooh, that one's beautiful. Do you see that right away? This is a supply zone. Supply. Okay. So we're going to put another number up here. We would expect this to be resistance, yeah, 125. Okay. Now, what about down and to the left? Okay, we want to find zones, right? Anybody see a zone on here? I do. In this teaching, do not go through candles to find zones. You have to go down, then left. You cannot go through candles. So if we follow down and we look left, notice we have a zone. Okay. Now, I also want you to take note, where does price keep stalling? Have we already tested the zone? Well, let's put that to the test. Right over here, we have two double inside and up formations. And if I come right to the top of this down candle that's in here, and I'll zoom in here in a second to show you guys. Pretty damn close, aren't we? And I'm probably off a little bit. Let's zoom in and see. I am. Okay. Let's open this bad boy up. See how things change when you open it up? So I did learn this that open this bad boy up because you never know. Okay. Want to go right on top of that, just like that. Then we come down here, very, very close. Okay. Very close. So this is going to be my demand zone. And in this case, I actually want to come up right underneath this candle, about right there. Because the buying pressure, let me zoom in for you. The buying pressure is underneath this candle. Boom, right? That's where the buyer stepped in, okay? So I'm going to take the level of these right here, almost like a trend line. I'm touching both of them. And then I want to take this level, boom. And then I get two levels. Let's see how these would pay out. Now the question is, like we just showed you on Google, the question is, did we hit demand zone? Do you guys have any, what do you guys think? Do you think we hit demand? Maybe. We might have, right? These levels here are about 101 to 95. So I like the 100 to 95 on this trade. Okay. And let's see over here on Google, what do we say? 92 by 90. It's probably more expensive. Oh man, it's already 35 cents. Damn it. We're already off. You guys beat me to it. All right, we'll put that on there. And then on this one, Amazon, we're saying 100 to 95. That's way down there, man. That'd be ugly. What's it trading at right now? I mean, those are 47 cents. And those pay out 10x, 453 bucks. And let's see what, and then when you're done doing this, you can come over here and take a look and see what the market makers are pricing in. So all you do is go to analyze, and then you go to earnings, and then you type in Amazon, and they're saying about a $9 move, folks. So, if it's a little bit more than a standard one deviation for these guys, then we'll hit that target. I would much, now I'm going to tell you on the put side here, I would much rather see if they can bounce into the close before I buy these. I'd much rather get these a little bit cheaper. Now you can make it cheaper by, changing the numbers up, you know. Maybe you do like a 105 to 100, that's 80 cents. You could do a 102 to 100. Oops, give me 1 second here. Yeah, 102 to 100, and those are 29 cents. Okay? Cuz I mean, we're saying 100 to 95. So if we were to drop below that 100, we could get paid here. So 102 to 100, those are only that much. So, and these pay out, same thing, 30 bucks for 170. So we'll put that on there. And again, these are just, and then on the long side, I'd be looking for 125. And I feel like 125 is probably expensive with 85 days out. Let's see. They're 515 by 525. So what we're going to do is we're going to do 120 by 125. That's what I'm going to do. And those are $1.85. Now, the other one, does it cover my cost if I'm wrong here? You know, Actually, 125, 130. Those are $1.45. And that gives me 100% there. And let me go back just one more time to make sure. Buy and sell. And that pays me. So what I'm looking at is our debit spread on this. That pays me 170 bucks. Okay, so I don't want to spend over $170 on my long-term trade. I don't want to pay over 120. We're getting close. I'm gonna find you. But we also want a nice reward if we're right on the long side, you know? So 120 by 125. These are $1.83, so that's too much. Let me make sure. So 125 is the supply zone. And then we got 135, 85 days out. Anybody ever hear of Santa? This would definitely be a Santa rally, you know? 85 days puts me where? That puts me in 20 January. Could try 16 December. It's 50 days. And let's see how much those are. $1.65. Could do $1.25. And the idea of this, okay, is if we hit the put side, I don't want to spend a lot of money on the call debits because if I'm wrong, I don't really lose any money here. If we go straight down, we collect like we did on Meta, um, but I'm able to buy back the short side, and then I want to make sure I have a good position. Like you don't want to be so far out of the money just because it's cheap. You want to make sure that you have a level that you can actually trade against. Okay. Honestly, Chris, I think the whole rally thing has been really crappy for many years into Christmas. If you guys haven't heard me, my wife always tells me, she's like, stop trading in December. It really is horrible. There's too many psychological things that go on, man. Right? I think so. And this is what I want to do right here. So I'm going to do a 123 by 125. So my total cost um, for this entire trade, okay, is only $1. I mean, it's actually 92 cents. Okay. So Google, this is a hedge that pays for the trade if we drop. And Amazon is just we got to call it a lotto. I hate to say that, but I'll just call it an earnings trade. You should consider this a zero trade. Okay. All right. Any questions about what I do there? Now, I'll tell you that, like John, right? He's really smart with options, John Carter. And I'll tell you that, for him, if he had the same strategy around supply and demand, that he would most likely say, hey, John, why not sell the iron condors around your zones, right? So just so that all you guys understand that, I'm pretty sure that's what he would probably say, you know. Um, Iron Condor is kind of his thing, you know. And it makes sense from a perspective of, hey, a price hits supply, we come back down, right? A price hits demand, we push back up. So what happens is the premium is killed on both ends. You get to pay. You get paid. All right. The only time that I don't, this is why I don't do iron condors because I believe in Murphy's Law. I'll probably do an iron condor and be like, hey, we're pretty safe. And then we get something like that. Or we get something like this, right? And I've seen that happen several times. And I do not want that to happen because yeah, I just don't want to get exercised or I don't want to, I'd much rather be on the debit side when those type of things happen. Make sense? It's okay to disagree with me too, guys. Like if you don't like something or it doesn't make sense, just say so. I'm not perfect. Thanks, man.